Good morning, ladies and gentlemen, and welcome to Financial Services Expo. And this is day 2. Welcome back to those of you who attended yesterday and came to some of these conferences, and further welcome to those of you who, if this is your first day here. This morning's session is a broker panel session. And the idea of these sessions is that you, the audience, get the opportunity to ask the brokers as many questions that you want to ask, and you have a certain degree, I suppose, of anonymity sitting in the room, any difficult questions that you might like to ask them. I'll start off, if I may, with one question. What do you think the figure will be, gross lending figure will be for next year, possible net lending figure, and why?
Gross lending is always an interesting number to try and estimate. I think we've got it famously wrong this year, every time, but this year famously wrong. I think the most optimistic forecast we've had from one large lender is as much as 190 billion next year, which would be an extraordinary achievement given where we were last year, 140 odd billion. So all fueled by funding for lending, Help to Buy 2, and all the other initiatives that are going around at the moment. So that's at the top end. Do I think it'll be 190 billion? That does look extremely optimistic. I think all the noises from, although they're eye-catching initiatives from the Tory Party conference and Help to Buy 2 coming forward and all the rest of it, look very good. I think 190 looks quite challenging. If for no other reason, I'm not sure that all of the processes are in place, severe shortages, processing, challenges at lenders and so on. I'm not sure whether it could even cope with that level of volume. So I don't know what the rest of the panel think, but somewhere between 170 and 175, I think.
I would imagine the people in this room would be more interested in what percentage we think is going to go into the intermediary market as opposed to the bank distribution.
You can add that on as a supplementary if you wish.
And I think in that context, what I think we've seen this year is a 50-50 split at the beginning of the year, go to a 60-40 split into the intermediary market, which is why I think most of our figures are higher percentage-wise than what the CML are putting out, and that's because as intermediaries we're doing the bulk of the business, which from everyone's perspective in this room, that's great news. So my view would be that I think that will continue to grow in next year. So if anyone in this room is in the mortgage business, as I imagine they all are, and your income is not up again by another 10% next year, then you are missing your market share, would be my answer. Regarding the net figure, that depends how attractive you as lenders keep bringing out remortgage products to take business off each other. So that will stay pretty flat, I would imagine, but I would imagine the gross figures will go up.
As it's not a lender panel, I won't be answering that question.
Okay, you can do that later.
We'll ask you that one later on.
Thank you.
I think from our point of view, probably somewhere between 180, 185 seems to be the consensus. If you add everybody's together and divide them by the number of lenders we've spoken to, 180 to 185 seems to be fair. I think I agree with Mark on the point on intermediaries. If the market goes up 10% next year, I think intermediaries will go up 15%. So I think the opportunity in the market is around what the intermediaries can do to increase their capacity, be able to cope with that, and also to look at some of the opportunities around the remortgage sector. And I think that's the unknown at the moment. Is there enough capacity out there to really focus where we want it to be in the remortgage market as well as the purchase market? I think from a net perspective, lenders have stopped deleveraging, so there isn't a rush to remove stuff off balance sheets and try and shift it elsewhere. So I think net lending will grow. And I think the factors that will possibly cap that growth at 185, somewhere around about there, rather than maybe the 190 or even the 200 that I heard in a bar one night somewhere, is the fact that we have not got enough houses, and that's still the main problem that we've got out there, that there are not enough houses being built, particularly in the London and South East areas, and therefore there are some caps that are going to be on the ability to write more than a certain amount of business in the marketplace.
Well, I think they're all being negative. I think brokers will be over 100 bill next year. I think it'll be over 190. I think we'll be over 170 this year. Don't know what all the fuss is about. We've got a great opportunity in broker land to grow, I don't know, between 10 and 15%, maybe even 20% next year if you're good at what you do. I can't see any reason for stopping things. We've slightly got positive house price inflation across the country now. Take out London and the South East. And it's still tough out there. Housing transactions have been long-term run rate 1.3 million since the war. We're running about 700,000 at the moment. That means we're about 600,000 short. If half of them need a mortgage, it'd be more than 190.
I think it will be above the 170, and I do totally agree. I think the swing to the intermediary market is going to be really strong, and I think that's really difficult to predict. I think we probably can only do that quarter by quarter, because I think lenders are going to have to, the first quarter, going to be obviously distracted, and then they will adapt where they want the distribution going, depending on how successful they have been in the MMR transition. But I don't think above 170, but as Nigel says, and everybody said, it will be regionalised where the growth is, but it's a good, it'll be much better than this year, and a much better last quarter this year as well.
Okay, positive messages, I think, from the panel. Growth, and particularly growth in the intermediary share. So
Yeah.
good news probably for most people within this room. So I'll open up the floor to any general questions. Okay, it's back to me then, guys.
Carry on.
Please, John.
Nigel, a couple of weeks ago you wrote an article, I think it was in Mortgage Strategy, and you kind of mentioned there that proc fees need to be addressed, and at this moment in time, I don't know how many people are right behind you marching to the head offices up in Halifax and down to Swindon, banging on the door of all the lenders to say, you must give higher proc fees for all the work we're doing. I'd quite like to know where you are with that, bearing in mind a journalist has just walked in. But do you not think before you sort out the proc fee situation that we have to get equality between the directly authorised and the network members? Why now, with all the metrics in place, all the lenders could tell me, you, who's doing what? We know for virtually every lender, the number one intermediary is a DA for their business placement. We know in the top quartile for most of the lenders, the biggest, let's say, DA distributor in the country, namely PMS, is always in the top quartile. So surely the time has come now for all the DAs to get what they deserve, equality with regard to proc fees. I've asked the question.
I'll take it in two parts. The point I was making about proc fees is post-MMR, we're taking a lot more of the risk, compliance, oversight of the advice from the lender. The lender is then responsible clearly for affordability. And my view on procuration fees was because of post-MMR, we've got to invest in oversight, we've got to invest in spam break, we've got to invest in compliance, and we're taking full responsibility for the advice piece. My contention was that as a consequence, the procuration fee doesn't quite reflect that at the moment and should be increased. I'm not quite sure how many people are leading me up the road to say Swindon with Ian behind you, but it's a reasonable argument, and it's an argument that I think will gather muster over the course of the next few months. I also think that the spread in proc fees needs some explanation from lenders. There are some lenders who pay me a third less for buy-to-let business if I go through them than if I go through another lender. Now, I'm obviously not condoning product advice or bias, but that should also be subject of something that I don't quite understand. Why I can get paid 35 for one and 49 for the same product. So that seems to me slightly strange. And that then comes back to, and taking that point further, you then get into the DA versus AR. There's been a lot of historic stuff about DAs and ARs, but I think with the increasing metrics, the increasing number of times that we contact lenders that can be analysed, you can analyse the impaired loans much better. It's then down to a lender to decide whether they want to reflect whether there's a breadth there, whether DA's biased one way or the other. I don't know enough about it. I've just got a little panel and a network that I look after. So, your contention is absolutely right, but, that will come forward as the metrics and the quality discussion goes forward as well, I think.
This has been quite a hot topic over yesterday and today, so I'll be really interested in the views from the other panel members, if that's okay.
Yeah, sure. I mean, I'll pick up first, and I don't think there's any argument that brokers are doing a lot more work for their money now than they were several years ago, and that's market factors have driven those fees to where they are at the moment. And I think there's an understanding in the marketplace that things need to be looked at and see whether we can do anything on those. I don't think it's as straightforward as DA versus AR. I think some very, very good quality ARs who do very, very good quality business, and equally I think some very, very good quality DAs who do very good quality business. I think it's looking overall, and also there's things to bear in mind, particularly with large distributors like ourselves, as to where that benefit comes in terms of exclusive products, how those are factored in, and in an intermediary world, would we prefer sometimes a better product or a better procuration fee? So I don't think it's as simple as saying they need to go up across the board. I think they need to be reviewed. I think there's an opportunity now for lenders to make their own decision on whether that's the right time to move it, but we also need to look at who is giving the good quality, and it's not necessarily AR or DA. There are good ARs and good DAs.
Can I just add, I do think there needs to be some levelling, because I'm not sure how you can justify the differences across distributors, but I do think we need to be careful what we wish for in terms of relying on the proc fee as our sole source of income, and we should be looking at what we do as a kind of more holistic advice. And unfortunately that comes at a price, or fortunately that comes at a price. We're professionals, we will need to charge it to the customer, and whatever way it comes through, whether it comes through increased proc fees from the lenders, that's going to be factored in the pricing of the products that the consumer's going to get. So I think we need to look at it more holistically and move away from completely relying on proc fees as our main source of income. And also, just to add, I don't think brokers have taken more responsibility as a result of MMR. We've always been responsible for the advice. We've always had to do that. Where we're going to have the challenge and the extra work is actually providing the information to lenders that they need to satisfy their affordability responsibility, and we're waiting to see what that is, and that might bring a need to actually get some increased payment to give you accurate data, support you in that quest, because you are ultimately responsible for the affordability.
Yeah, so the lenders pay proc fees, and the proc fee is made up of for the broker. The broker, you are all marketing your services to clients to get them in the door. Then you're doing the work. There's a lot of administration from seeing the client all the way through a 3-month process on a purchase case, and then you're providing suitable advice and taking the risk on that advice for the customer. And all those things are part of the proc fee payment that you currently receive. And some of you may be charging the client a fee on top of that for the advice and services that you give. And there's a fourth or fifth dimension that I think John was alluding to about mortgage market review and quality of business from lenders. And I think that one of the issues from the MMR, and also from the thematic reviews that lenders were asked to look at 2 years ago from the FCA, was how do you know the broker, and how do you know the quality of the business that they are submitting to you, and what risk does that present? And I don't think most lenders have consistently answered that question in a way that means that they can price their proc fees for the quality of business, because there are some fantastic directly authorised brokers and some fantastic network members from all of our distributions. And the problem is until you've worked out what you're looking for, I think it's quite hard to price. So we are where we are, which is a mishmash of the history of markets pre and post MCOB. I think the principle, though, of rewarding brokers for the quality of the work they do is if we just focused on that issue, would actually, I think, level up a lot more the payments that we will receive. I think the issue is most lenders have a different view on what that quality looks like, and I don't think the regulator has also provided sufficient guidance for all lenders consistently. So I think the spirit is there, but I think there's a lot more work to do with the regulator and lenders to work out what that true cost of that payment is and what it's for.
And finally, Mark.
Well, it's difficult to add without repeating what everyone else has said. As a generalisation, I have no problem with there being a level playing field. If the quality of business is good, it's good wherever it comes from. I think much too much is made of DA versus AR. I think it's irrelevant. We're all doing the same job. And from time to time, people move from DA to AR and vice versa. I think the challenge for us all, working collectively together, is to agree a charter of what good looks like. And I think it's fair to say the better quality of the business, then the more profitable it will be for the lenders. And I think we've got to all work together to find out what good looks like, whether it's DA or AR business.
Actually, just one other thing. I think that the other still unknown is as a network, you do ultimately carry the responsibility for the advisor's advice that you give. So there is an extra layer of responsibility in the process, which I think, back to my original point, is currently uncosted and unvalued by lenders well enough for us to know whether an AR premium is correct. I think if we knew, then it might be easy to have this debate. But I don't think that work has been done yet. And you're running a network and we're running a network, but it's just unclear.
And I think if you link it back into, as I say, if you link it back into the quality argument and look at the different lenders, I've had lenders talk to me and say our quality's gone up because we recognise quality and we pay on quality, and I've had other lenders saying our quality's gone up because we don't pay on quality. So I don't think there's as we said, there's no answer in the market that says quality is the right way to remunerate. And I think lenders' quality generally is going up. Broker quality particularly is increasing, and that's for everybody in this room to say we are increasing the quality of our business, and lenders are reflecting that whether they pay on quality or not.
And I think that will be an ongoing topic through the rest of this year into 2014, past MMR. What is quality? How do we define quality? And actually, what are we looking for in terms of our strategic distribution partners? John, do you want to come back?
Can I just add one thing on the quality piece? Is we're kind of our poles apart, building on what John said in terms of from a network perspective, where we evaluate quality of advice, we're looking at the consumer outcomes. Did they get the right product for them? When lenders look at it, they're looking at, did they fit our criteria? Was the paperwork filled in correctly? And all of that. So we're going down two different tracks that still can come under the quality banner, but it is very different from how a network or a DA looks at the quality of business that an advisor does. It's based on different outcomes.
Okay. For years and years and years, I've suffered at the hands of the networks being told time and time again, all the principles of the network, you tell all the product providers, you control all your members. That's an absolute fallacy. I'm different to most of you guys because I've worked in a life company, and I can assure you, I know that all the networks can't control their members. We know that, you know that. I think we're at the stage now where I need all of the network principals to come together and put their hands up and say, no, we don't control our members. We provide the compliance and the regulatory systems for them to adopt. Because I can guarantee every single network has not got the people around the country to go into every one of their network members, sitting in their garages, sitting in their front rooms, sitting in there wherever. I know that is not the case. And you only have to speak to someone like Ken Davey. His biggest fear when he was running a network was his little man in Wales ripping off everyone in the community. And that, I'm afraid, is what this is all about. You've told me for so long you control your members. Gentlemen.
Okay, you can quote me on this. I influence the behaviour and the performance of the people in my network, and you can quote me on that. Does that answer your question?
I'll tell you something as well. I would like to think over many years I've actually influenced the quality of all the people that were part of PMS as well.
But that's not what you said. You said I didn't.
I said you control your members. You cannot. No one can
Yep.
control you.
We have another question from the floor anyway.
Hi, Philippa Colley, Pure. Actually, it wasn't a question so much as just going back to the original point was about proc fees. Proc fees obviously are procurement fees. It's about us as brokers procuring that business on behalf of the lenders. The lenders aren't procuring that client and are not likely to have had that client had it not been for us. That's what we're being paid for. It's not the quality of the advice. We're actually charging our clients for our professional services, for the quality of the advice and for arranging that mortgage. And I think there should be some sort of, not necessarily set fees, but there should be some sort of basis throughout the lenders so that you're not encouraging the bias. At the end of the day, this is about rewarding us for our marketing costs, for our overheads running our shops and our offices and our businesses, and procuring that client that way so that the lender doesn't have to. And if we're putting 60% of their business that they haven't had to pay to get, we have, that's what it's a reimbursement for. There's a muddying of the waters about saying it's about, charging for the quality of the advice. It isn't. It's reimbursing us for actually giving them our client.
Can I agree with everything you said, but the challenge is if all of your business was going to Nationwide because they paid a higher procuration fee, then that's a challenge, and it's a challenge for the network of how we manage that and how we make sure the client under our regime and our best practice is getting the right service. Correct. I'm not disagreeing.
Okay. Next question.
Hi there, Dave Oster from Mortgage Business. It's just to add to that lady's point about the perceived quality of business that we're presenting to a lender. And I just appreciate your comments on what you're doing with lenders with this particular situation. In this case, just involves Nationwide as a lender. So in a day-to-day running, you see your client on a Wednesday and you decide your product, you think you sign them up on Friday because you haven't got time to do it on a Wednesday, day off is Thursday. Nationwide send out an email on Thursday night saying you've got till 5 o'clock to submit the application. We're putting our rates up. So you've missed the rate pool because you're not in the office. You explain that to a client, that their rate's just gone up by 0.1, whatever it might be. They accept that, and then in that same calendar month, Nationwide cut their rates twice, having obviously put them up to stem the flow of business or whatever they decide to do. But within 2 weeks, they're cutting rates again. So the same client that you've already given the bad news to, the rates have gone up. They're now well aware the rates have come down, and it's going to cost them £99 to switch rates. Now, I appreciate it's a lender-specific example, but this is the thing we're talking about. If you're talking about quality of business, how that's affecting the way that we're doing our job. What are you guys doing to smooth that process with lenders to say that's just ridiculous to pull a rate at 5 o'clock on a Thursday night and 2 weeks later cut them down again?
There is a lender panel later on this afternoon if anybody wants to come and re-ask that question. But, gentlemen, I think it's your chance for a little lender bashing now, if you want. Over to you.
I just think we obviously work with the lenders very closely to try and get as much notice as possible, and I think that's the one thing we would always do: encourage lenders to give us as much notice so that those cases can come through the door. What we can't control is market forces and pricing differentials and rates going up or down, but I think what we can do is work very closely with the lenders, and we do, to try and get them to give as much notice when a rate changes, whether that's going up or down. Obviously when they're going up there's a bit more pressure, so we do try and get as much notice through as possible, and that is our job as distributors, to try and have those conversations and encourage lenders to give that notice.
Anybody got anything else they'd like to add?
I'd just add, the key thing for me when working with the lenders about quality is to make sure that the data's robust and that it's a fair discussion. And what do I mean by that? At the moment, impaired loans emergence is so low that one emerging IL can actually make a difference in the network rankings on a lender, and that isn't very fair. So you just need to, as long as the data and the implementation is done well, the concept of paying a little bit more for quality or a little bit less for poor quality is okay. It all comes down to the implementation. And the number of calls into an operations centre for a lender, if you're going to pay me extra on that, then I need to know exactly that they've got those number of calls right and that they've made sure that that's the right source. So it can get very, very complicated. In terms of product pools, it's always been the same. I remember, when you gave people half an hour to product pool and then you used to get loads and loads of complaints, and now it's pretty... Yeah. Yeah, and then you get penalised on your prop fee because you then change the lender halfway through the app and you move him to someone else. There's lots and lots of problems with that. Product pools are always going to be difficult, up or down. There's never going to be an easy solution. Countrywide's on Mortgage Brain, so we actually get about 48 hours before the lenders. So we're a bit privileged, but that doesn't make any difference. It's still the same principle. I think the key here is, one, notice, two, making sure it's done right, and three, let's make sure that we're being assessed. If we're going to be paid on quality and have metrics in that quality, that we can actually all understand the metrics and they're fair and we can influence them. There's no point. I can't do a lot about an emerging impaired from 3 years ago. I just got to say, okay, well, yeah, fine, that's one for me.
Okay, do you mind if I move this subject on a little bit? I was travelling last night to the dinner that they had here. So if any of you guys were at it, I'm sure you enjoyed it as much as I did. And one of the people I was travelling in the taxi made the comment that individuals want mortgages but need protection. With the market growing, do you think that protection could possibly now take a backseat?
Bloody hope not. It shouldn't do. It is one of the disgraces of the UK. We all remember I sold my first mortgage in 1987, and before I could get the completion, I had to give the little direct debit thing to say you got a life cover to cover that loan. It is quite disgraceful that a third of people who take out a mortgage get the right protection, which means that 2/3 don't. And yes, I'm sounding like Mark Groves. And we actually owe a duty to our consumers to say, what happens if the breadwinner passes away during that loan? We owe a duty to make sure that we have covered that in all instances. Countrywide's probably one of the better ones. Mortgage Intelligence is okay, but it still annoys me that about 40% of our clients go away with little or no protection. It is wrong. Should there be more impetus and should it be more invasive about making people take protection? I can't see how you do that under the customer outcomes and choice and all the rest of it. But it's a great sadness that in 87 everybody was covered, and in 2013 here we are, and we're talking about protection. It shouldn't go backwards. I have a fear it will do. You can already see it go down in the last couple of months if Aviva's stats are to be believed. We should sell protection, we should sell buildings and home insurance for contents, and we should sell a mortgage alongside of that, because those are things that a customer needs.
Yeah, I think I need to get in now because Mark Graves is going to spend the next half an hour taking up the rest of the...
when your reputation goes in front of you.
He's a fantastic advocate for protection.
Yeah.
I think that in the last 3 years, if you look at both in Sesame Network and in PMS, the directly authorised firms, protection sales have grown phenomenally. And that's because brokers tend to sell enough to make a living to start with. They have. That's what they've done. They've always done it, and you're tremendously entrepreneurial to be able to achieve that. But what we have seen in the last 3 months is those protection sales have flattened off because the scale of numbers of new mortgage inquiries have just gone through the roof. And I think that the challenge is as much about running a business efficiently and being able to get enough staff through the door to help you sell as it is about the need to sell protection. Because I think we've all learned a huge amount about how to sell better protection. But Nigel's absolutely right. The Aviva stats show that protection sales from mortgage firms has flattened. Their new advertising campaign coming out is going to be even more hard-hitting apparently than the last ones because we still need protection. even though the mortgages are going up, we still need to protect those mortgages for the clients. So I think it's a sad fact of just how much mortgage business has grown, that we have seen it tail off. But let's hope that we can carry on selling, because those clients still need the protection.
And I think it's very short-sighted. I mean, I think as things are at the moment, it's very short-sighted to say, I'm okay because I'm getting enough mortgages coming through the door. Businesses are here, and now is a fantastic opportunity for intermediaries to build their businesses for the long term with some really loyal customers, referrals, and the best referral you're going to get is when that unexpected thing happens and they go back to their friend and they say, you know what, my broker, I never even thought of this, I would never have taken it, but he recommended or she recommended that I took this policy out and now I'm covered and protected. That's a fantastic recommendation. The one that you don't want is where you're down at the pub and somebody says to you, you know what, this broker that I went to see just never told me about it and now look at the state I'm in. So there's a short-sightedness about concentrating on the mortgage, and there's a holistic, that Gemma mentioned earlier, opportunity now to look at the protection, the mortgage, and also don't forget the remortgage opportunities. You know, there's a lot of clients sat there at the moment who are sat on base rates. Market is going to go up, the rates are going to increase, and there's a whole another set of clients who need help and advice in the remortgage sector. So it's not just about protection, it's about remortgage and freeing up that capacity, either by being more efficient in the day-to-day processing, but also about looking, is now the right time to recruit either a protection specialist or additional staff, or is it the time to maybe even refer that to somebody else? Doesn't matter which one of those happen, as long as one of them does.
Gemma.
Just echoing that, but I'm amazed how short our memories are. You know, there's a lot of businesses that wouldn't have survived if they didn't have a protection book. And I think it's, and that wasn't that long ago. We've all been through that, and we just completely dropped the protection piece. As you say, the Aviva stats, the same in my network, we still dropped down as soon as the mortgage activity increased. And it's scary to think that we're talking about a much bigger increase in mortgage activity next year. How far is it going to go down? But you are doing your clients, you're not servicing your clients if you're not considering their protection needs. And if you don't need the money now, you're living to your salary, put it on the drip. Put it on the drip, put some future proofing into the business.
Okay, Mark, I'm not going to ask you.
No, don't ask him.
Because
we've covered all his
we
points
do. We do know how enthusiastic you are and what a great advocate you are for the business. So I won't skip that one if you don't mind. Questions from the floor?
Going back to the protection piece, obviously I'll give Mark his opportunity to talk about it now. How much do you feel that the drop in protection this year has been down to the gender directive putting the prices up and brokers now not being able to just sell on price and rebroke rather than actually selling on need?
Ooh, what a good question.
Mark.
Okay. I think the gender directive probably had an impact in the first quarter, but I think most of the life companies readdressed that and actually brought their premiums down. So I don't think it's a big thing. But the other bit that you said is a real hot potato for me. And I don't want to keep harping back to John's point, but if you set your strategy out about what you want to achieve in your network, and then you influence behaviour from the people within it, and you make and you change the rules about what you need to do to participate in your network, and you stick to it, and everyone knows where they are, then before you know where you are, you have a momentum gathering of a change of behaviour. So the first thing that we did was change from a 2-year clawback to a 4-year clawback, because I fairly quickly identified that a large percentage of brokers were selling life assurance in the way they were doing remortgages, which was to earn another commission every 2 years, which is part of the reason why they remortgage. So initially I got some uproar about it, but I explained why. So I had to do something differently rather than make them just do it because I'm telling them to do it, because it is difficult to tell people to do things when they come to you from choice. But culturally, if you move to a 4-year clawback, you've eliminated the reason to move the policy every 2 years. So you change the behaviour of the person making the sale in the first place. So they're now making a sale for the benefit of the client to keep that policy for the long term, rather than do a reducing term policy and turn it every 2 years. So I think that's quite key in terms of the strategy that you set out as a network in terms of what you want to achieve. And yes, I absolutely do agree that it has eliminated a lot of reasons for people to go back for the way they did before. But I think the opportunity, as everyone said, is absolutely massive, because there is just, such a fantastic opportunity to sell now. The training that is given by the life companies is second to none. They do fantastic training and support us. Lots of a raft of different ways to actually look after a client on the long term. And I think MMR has created a huge opportunity for us as advisors in making sure we look after our clients, because it's our responsibility to make sure that not only do we get them in the property, that we keep them in the property. And the biggest sale that I find staggering that is such a low percentage is income protection. Because just park your life cover for a minute. Our responsibility is to make sure that we not only can get the person the mortgage, but if any eventuality happens during the course of that 25 years, that family stay in the property. The lenders don't care because they've got the asset.
John,
I was going to add one thing to that. Maybe for those that are in the lender session this afternoon, or even the FCAs, one of the interesting things about a move to affordability from a lender's point of view post MMR is will the lender deduct or take out of long-term commitments the sale of life assurance or income protection or other good things for the client that help protect their mortgage and the customer's life? Wouldn't it be good if, to help us sell more protection and other insurances, some benefit was given by lenders under their affordability criteria? I throw that one out there just to see whether
there are no lenders. This is not
whether
the lender
that would
panel,
be
so
a useful
we'll save that
benefit
this
for lenders.
afternoon.
But I think just final on that point, the market at the moment is, there's a huge move towards the first-time buyer in the new build sector. There are people walking out of new build houses, first-time buyers, without that protection. That's criminal. That there are real opportunities in the first-time buyer sector, and that's not affected by gender or anything like that. Pricing is the right thing to do, particularly for first-time buyers who walk away with no protection.
Wouldn't it be better if you influence the providers by suggesting that they bundle products so that they do get all of these product sales in one bundle, and also increase persistency by insisting that your members sold protection products, particularly into trust? It's an absolute disgrace in this market that only 7% of protection policies are in trust. What that does, if somebody dies, is tie the proceeds of that protection policy into their probate, and it can trigger an IHT charge. It's time you influence behaviour with trusts.
Absolutely.
Okay, probably more a statement than a
absolutely
comment.
Agree. Yeah, absolutely right.
And I think that there's people getting caught up on price being the driving factor. Advice is the driving factor, and trust is absolutely. I agree 100% with you.
Okay, we're coming to near the end of this session, so I'd like to finish with two questions and short, sharp answers, please, from the panel. Question number one is related to government intervention. We've seen the announcement of Home to Buy 2 on Sunday morning. My question to the panel is government intervention still required?
Yes.
Maybe slightly more than yes, Nigel.
Right, government intervention has led to funding for lending, reducing mortgage prices by 1% across the piece, making them more affordable for all. Massive impact. If we didn't have help to buy shared equity, there's 12,500 first-time buyers who wouldn't be in new homes of their dreams today. And if we didn't have help to buy 2, I don't think you'd see, outside London and South East, I don't think you'd see the housing market move forward in the way that we would all want to in this room.
Okay.
Therefore, absolutely essential, yes, it needs to happen.
Thank you.
Agree with that, and the only thing I'd add on top of that is that it's giving the builders the confidence to build houses. So that's what we're seeing. We do need it, because without that, the builders wouldn't have the confidence to put spades in grounds and build more houses. And if they keep doing that, then we've got a chance of getting through this. It's still very fragile. It's still very regional. So we've got to keep the incentives and the initiatives there.
Yes, but we need more houses.
John?
Yep, just remember that all of these government schemes were originally set up to fund growth in the UK economy. They weren't set up to provide cheap mortgages. That just happens to be a byproduct of helping builders build and the economy grow. So we shouldn't forget that all of our neighbours in Europe and elsewhere are in pretty much poorer place than we are. So keep going with the government schemes to keep us competitive.
Gemma.
Yes, and just it's bringing back consumer confidence. I think there's a lot of consumers out there that assumed they wouldn't be able to afford a mortgage and haven't been put themselves forward to ask, will actually come forward now and ask about it. So it's the consumer confidence as well as the building confidence, so definitely.
Excellent. Okay, we'll work our way back down the panel this time. So Gemma, you'll be first. What one thing would you tell a broker that he or she needs to do in 2014 to make sure that they are winners in the new market?
Focus on the quality of your business, and I don't mean the quality necessarily around from a lender's perspective, but the overall quality of your business. Future-proof it, and don't look back too much, but don't forget the lessons we've learned. And it's the advice, the holistic advice, that's really important. So looking at designing your strategies for your business that you can actually service your clients holistically, and don't go back to being transactional.
Yeah, I agree with all of that. It's all about building a business now. We've got a great opportunity with more mortgages and more confidence in the economy. I wouldn't take the eye off the ball. MMR is around the corner. It will have an impact on all of our businesses. So I would stay close to your preferred distributor network club to make sure you're fully up to date on what's going to happen post MMR.
Make sure your client has a fully protected mortgage so that they can stay in it, and if they can't afford it, you shouldn't be doing the mortgage in the first place.
Be holistic, look at new build as a sector if you're not in it already, and look at remortgages. That's where the market is for next year, new build and remortgages.
I think we're facing a recruitment crisis, and it's going to get worse with MMR. I think the lenders will pick and choose to CMAP qualified guys. I think we're all in trouble in that regard. If I were to say anything to brokers at the moment is go out hiring, hire now, recruit them and keep them, and your business will grow because the market's going to grow next year.
Ladies and gentlemen, can I just take this opportunity to thank the panel members for the very forthright opinions. I think it's been an excellent discussion here this morning, and if we could just show them our appreciation in a normal manner.
Well done, Matt.